For 20 years, property was the Australian wealth answer. But this week, auction clearance rates hit 34.2% in Sydney. That's the lowest since 2008. So we ran the numbers. All of them. $500,000 in property versus the same $500,000 in stocks. And the answer is messier, and more important, than you think. Quick question. Are you sitting on the assumption that property will always go up? Or are you trying to decide right now whether to buy a house or invest in the stock market? If either one is you, this video is going to change how you think about money. Here's what most Australians don't know. Property is not the safe investment anymore. It's the expensive, illiquid, heavily leveraged investment. And the stock market is not the risky bet. It's the diversified, tax-efficient, accessible wealth machine. Let's cut through the emotion and look at the actual numbers. The average Australian property in Sydney costs $1.20 million. The average investor puts down a $240,000 deposit and borrows $960,000. Over 30 years, they'll pay $2.10 million in interest alone. That's $70,000 per year in interest on top of rates, insurance, maintenance, and eventually, capital gains tax. By contrast, $500,000 invested in a diversified ASX 200 ETF at 7.5% average annual returns grows to $5.40 million over 30 years. No interest payments. No rates. No maintenance. Just compound growth. But that's the headline. Here's where it gets real. Most property investors don't feel that pain because they're looking at property as leverage. You put down $240,000 and control a $1.20 million asset. If it goes up 3% a year, that's $36,000 a year on your $240,000. That's 15% annual return on your deposit. Stocks don't work that way. You invest $500,000 and get 7.5%, which is $37,500 a year. No leverage, no risk of losing the house if the market dips. Here's the problem with that logic. First, property prices don't go up 3% a year anymore. The Australian Bureau of Statistics data shows property growth has slowed to 1.8% annually over the last 3 years. At 1.8% growth on a $1.20 million property, your annual gain is $21,600. That's much less than the $37,500 you'd make from a diversified stock portfolio without any leverage risk. Second, you have to actually borrow that $960,000. At 7.2% interest, today's Australian mortgage rate, you're paying $69,120 per year in interest, plus $8,000 in council rates, plus $1,500 in insurance, plus $4,000 in maintenance. That's $82,620 per year in pure costs. If your property grows at 1.8%, that's only $21,600 in gain. You're negative $61,020 per year just waiting for appreciation. Now let's flip it. The same $500,000 in stocks through a diversified ETF costs you almost nothing. ASX 200 ETFs charge 0.06% annually. That's $300 per year. Your $500,000 growing at 7.5% is $37,500 annual gain. You're positive $37,200 per year. But wait, there's a tax story here that completely changes the game. Property in Australia gets a capital gains tax discount. You can hold a property 12 months, sell it, and only pay tax on 50% of your capital gain. So if your property grew $200,000, you only pay tax on $100,000. Stocks, same deal. Long-term capital gains get the 50% discount. But here's the advantage stocks have. With stocks, you can strategically sell winners and harvest losses to offset your tax bill. You can hold certain positions 20 years, certain positions 2 years. You get daily liquidity. Property. You wait. More importantly, stocks pay dividends. The ASX 200 yields about 3.8% on average. That's $19,000 per year on a $500,000 investment. You pay tax on those dividends, but you receive the income every quarter. Property gives you nothing until you sell. Let me run you through the realistic scenario. You have $240,000 saved. Do you buy a $1.20 million house with 80% leverage, or do you invest it in stocks? Property. Your $240,000 buys you an asset worth $1.20 million. You pay $69,120 per year in interest, $8,000 in rates, $1,500 in insurance, for $1,000 in maintenance. That's $82,620 per year in costs. Your property grows at 1.8%, which is $21,600 per year in appreciation. You're out of pocket $61,020 per year, but you're living in the house. So the rent you're not paying covers some of that. Average Sydney rent is $2,400 per month, or $28,800 per year. So your real cost is $32,220 per year out of pocket to live there. Over 30 years, that's about $967,000 out of pocket, plus your original $240,000 deposit. After 30 years, your property is worth approximately $2.10 million. You sell it, pay capital gains tax on the $900,000 gain, which is $450,000 taxable gain. At 45% tax, that's $202,500 in tax. Your net position, $2.10 million minus $202,500 tax minus $967,000 in out-of-pocket costs minus your original $240,000 deposit equals $690,500 actual wealth creation. Now stocks. You invest your $240,000 in a diversified ETF. You don't have leverage. You're just buying the market. At 7.5% annual returns, your money grows to $2.07 million in 30 years. You take $37,500 per year in dividends, which is $1.12 $5 million over 30 years. You pay tax on those dividends at an effective rate of 30% across 30 years, which is about $337,500 in tax paid along the way. When you sell after 30 years, your cost base was $240,000. Your asset is now $2.07 million. Capital gain is $1.83 million. Half is taxable due to the capital gains discount, so $915,000 taxable. At 45%, that's $411,750 in tax. Your net position, $2.07 million minus $337,500 in accumulated dividend tax minus $411,750 in capital gains tax equals $1.32 million in actual wealth creation. Over 30 years, the stock portfolio creates $1.32 million in wealth. The property creates $690,500. Stocks win by $629,500. But here's the massive caveat. Property has given you a place to live. Stocks have not. So you need to add back the $28,800 per year in rent savings, which over 30 years is $864,000 in housing cost avoided. With housing factored in, property creates $1.55 $4 million in value. Stocks create $1.32 million in wealth only. Property wins by $234,000 once you account for the fact that you had somewhere to live. But that's the 30-year horizon. Most Australians are not thinking 30 years. Let's look at 10 years. Over 10 years, your $240,000 property grows to $1.42 million. You pay $826,200 in total costs, $288,000 in rent savings. Your net position is roughly $305,800 in wealth creation. The same $240,000 in stocks grows to $486,000. Your net wealth creation after tax is around $188,000. Property still wins in year 10, but only because of leverage and rent savings, not because property is a better investment. It's because you borrowed $960,000 and got 1.8% on $1 million asset. That math breaks down if property stops growing. And here's the real 2024 question. What if property in Australia grows at 0.5% for the next 5 years instead of 1.8%? Auction clearance rates at 34.2% suggest people are losing confidence. When confidence falls, prices soften. If property grows at 0.5% instead of 1.8%, your $1.20 million asset becomes $1.24 million in 5 years instead of $1.30 million. That's $6,000 per year in appreciation instead of $21,600. You're still paying $82,620 per year in costs. You're negative $76,620 per year. Even with rent savings, you're out of pocket $47,820 per year. Meanwhile, your $240,000 in stocks at 7.5% becomes $348,000 in 5 years. You've created $108,000 in wealth. You've had complete liquidity. You've paid minimal fees and taxes along the way. So what's the answer? Property or stocks? Here's the truth. If you already own a home where you live, that's settled. Don't sell. You own a productive asset that gives you shelter. But if you're deciding between buying your first property or investing in stocks, the 2024 data says this. Stocks give you better risk-adjusted returns. They give you liquidity. They give you tax efficiency. They give you the ability to stay diversified. Property gives you leverage and shelter. That leverage works beautifully when prices are growing at 3% per year. That leverage kills you when prices are flat or falling. In 2024, with auction clearance rates at 34.2% and property growth at 1.8%, stocks are mathematically superior for wealth creation. Here's your first step today. Take your next $5,000. Don't put it down as a property deposit. Put it into a diversified ASX 200 ETF at your bank. Set it to automatically invest $500 per month going forward. In 5 years, at 7.5% returns, that becomes $38,000. In 10 years, $96,000. In 20 years, $680,000. That's the option most Australians don't explore because we are all taught to buy property. But the numbers don't lie. In 2024, they've changed. The stock market is the smarter play.